I've been very bullish on growth. I've been very bullish. I've been thinking inflation is going to rebound. I still think the Fed cuts in June because they telegraphed it. Um, and I think it politically it would be too charged for them to not cut. I think it will be a policy mistake to cut. Um, but I still think they'll go ahead and do it.
And forget going to 8%, like Jamie's talking about. If we get back to 5 or 5.5, 6, I mean, those start to become very scary numbers to the stock market, but it also incurs a lot of damage on bondholders.
We're discussing the state of the market's valuations, whether or not we are currently in an inflationary or deflationary cycle, and the course of monetary policy with our next guests, David Hay, Co-CIO of Evergreen Gavekal, and Louis Vincent-Gave, CEO of Gavekal. Both talented and well-liked popular guests who have been on my show. First time we've had them both together at the same time. Welcome, gentlemen. Thank you for being here. An honor to host you both.
Thank you for inviting us back, David. It's always kind of a surprise when we get a re-invitation.
Not really. The viewers love both of you. Louis, I've spoken to once, so welcome back. Let's start with...
Thank you.
Yes.
Thank you for the kind words, David. And for the invitation. Thank you very much.
You're welcome. Thank you. Louis, let's start with you because I haven't spoken to you in a while. You have very interesting research on Gavekal. I invite everyone to check out your work. We'll put the link in the description below. Let's talk about some of your more recent research on inflation and the asset booms that we may or may not be seeing right now. How would you assess the current inflationary cycle? I think what most people, investors in particular, want to know is whether or not inflation will return, thus prompting the Fed to raise rates or perhaps even just keep rates longer for higher. Or higher for longer, rather. That's what I meant to say.
Yeah, no. I think I caught that.
Yeah.
So look, I think the first thing we have to acknowledge is that in the past 2 months, most of pretty much all the manufacturing data around the world has been coming in very strong. You look at ISM surveys, you look at OECD leading indicators, you look at industrial production numbers. So from economic data perspective, everything is telling you we are on an upswing of the global manufacturing cycle. And we can go into why that is, but the data is the data. We are in an upswing in the global manufacturing cycle, according to the economic data. Now you turn to the market data, and you're getting a very strong confirmation of that very same trend. Copper prices breaking out to the upside, most commodity prices moving higher, and perhaps most importantly, in order to answer your question on inflation, energy prices moving higher. Now, for me, this move higher in energy rests on a number of pillars that I think people are underestimating. The first pillar is, of course, this upswing in the global manufacturing cycle. Manufacturing, industrial production, that is extremely energy intensive. So when you move in an up cycle, usually demand for energy goes up. And unless you have a massive increase in supply in the pipeline, then energy prices go up. But that's not the only reason. I think the second reason is, and I think this is super important and people are underestimating this, is that basically the Chinese economy has bottomed. In the past 6 months, Chinese policymakers have eased both monetary and fiscal policy aggressively. And as you would probably expect, Chinese economic data is now starting to pick up. Now, in my career, each time China's picked up, each time China's reaccelerated, it has had an impact on commodity prices and especially on energy prices. China is still the biggest importer of energy in the world. Now, the third factor on energy, also super important, is that India is becoming a big importer in its own right. And India today is going absolutely gangbusters. India, like for the past 3 quarters, Indian GDP growth have outperformed expectations, not by 10, 20 basis points, but by 200 basis points. GDP in India is just booming. Now, part of that, of course, is that the economy is being cranked up into the run-up to this month's election. But, with the kind of stimulus that you've seen in India, this thing is, it's off to the races. And then finally, fourth, and most importantly, there's something that's everybody's massively underestimating, something that I keep highlighting in my pieces. And that is that in the space of 4 years, China has gone from nowhere to become the biggest car exporter in the world. Um, and China now exports more cars than any other country. If you take just Mexico at your border, well, the U.S. border, um, Mexico now the best selling car country in Mexico is now China last year for the first time ever. Now, here's the important part. China is doing this by selling cars to people who've never bought cars before. When you look at, you know, Japanese car exports have plateaued, European car exports have plateaued, US car exports have plateaued. Chinese car exports have boomed. They've created a new market. They've basically created the sub $10,000 car market. And what they're doing is selling cars to people across Latin America, across the Middle East, across Southeast Asia that would have never bought cars in the past. And as people start driving these cars, of course, that creates new demand for energy. So bottom line, we have pickup in the economic cycle. And yes, energy prices are going up. Yes, food prices are going up. All that leads to higher inflation. Now, against that, you could say, well, so the Fed isn't done cutting. The Fed isn't going to start cutting. I don't know. I still think I've been very bullish on growth. I've been very bullish. I've been thinking inflation is going to rebound. I still think the Fed cuts in June because they telegraphed it. And I think it politically it would be too charged for them to not cut. I think it will be a policy mistake to cut. Um, but I still think they'll go ahead and do it. They'll signal one more cut. So we're going to get two cuts from the Fed and done, which is pretty much what the market is now starting to price in.
We're going to continue the conversation with Louis Gav and David Hay on inflation and their outlook on the economy. But first, a word from our sponsor, iTrust Capital. A shout out. iTrust Capital is an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you'd like to learn more about how you can get started, click on the link down below, iTrust.capital/David. And you can get a $100 signing bonus if you fund your account with my link. iTrust also offers unique tax benefits, so if you're over 18 and you'd like to open a new account or roll over an existing account, click on the link down below, iTrust.capital/David, to learn more. I want to come back to what you said, Louis, about why it may be a policy mistake to cut, but I want to give David a chance to respond first. So I'll let David respond to the same question. And to add to what Louis has said, David, do you think that the Fed will cut this year? The CME Fed Watch tool is predicting a 63% chance that there will be that the rates will be between 4.5% to 5% by the end of the year. This is as of Monday, April 8th. It changes by the hour, as you know. And so, investors would like to know your take on this.
I think so. I think it's pretty clear that Powell would like to cut. I think he's doing everything he can to minimize all the very persuasive data that Louis just articulated. You know, he doesn't seem to have any of that stuff on his radar right now, which is pretty amazing. I mean, Louis, I know, is aware that if you look at core services, CPI is running at about a 10% annualized rate over the last 3 months. And if you look at the total compensation growth, it's in the 4 to 5% range. It's pretty tough to get inflation down to 2% when you've got wages growing at the 4 to 5% level. But I think he wants to do it. I think that there is, even if he doesn't admit it, I think there's a desire on his part to see Joe Biden reelected. And I'm not saying that's his only reason. I think he's got plenty of other reasons to want to cut. But I think it is the way the economic tides are shifting right now. It does seem to be more towards Louis' inflationary boom scenario. And I've been more in the stagflation camp, so I believed in the inflation part of it. But to me, I still think it's quite mixed. He's heard me say this a jillion times, that I just am so confused by all this conflicting data. But lately, it has started to get a little stronger. And Louis making a very good point that if you look at the industrial part of the U.S. economy, that clearly was in recession over the last couple of years, and it does look like it's rebounding. I think even Germany is showing signs of recovering, right, Louis, of all things?
No, yeah, that's right. Yesterday's German industrial production number, I think the expectations were for 0.4%, and it came out at 2.1%. So even Germany's bouncing back, even China's bouncing back. The rest of emerging markets have been in an epic boom, ex-China. Japan's been very strong. So it's hard, like, the the obvious pocket of weakness in the world was Europe, to your point, and especially Germany. And even that seems to be turning around. And I think behind this boom in industrial production, you have a number of factors, but perhaps the simplest one is, frankly, we've underinvested in so many industries for years and years, not just the past year, but for decades, assuming that, you know what, we don't need to invest in industry because we can always produce in China for cheap. Now, the reality is for both, well, for geopolitical reasons, the whole we can produce in China for cheap has gone out the window. Um, but in fact, producing in China isn't that cheap anymore anyway, because wages there are no longer as low as they used to be, and there's inherent costs, including, as we're finding out, if you're European, the problem with shipping and whatever else. So bottom line, yeah, I think we're in a new upswing in the global manufacturing cycle. Again, there's two ways to form an opinion. You can look at economic data, and the problem with economic data is it tends to be, liable to be modified down the road, and it comes out late. And you can look at market data, but when the market data and the economic data points in the same direction, it's for me that's a pretty potent message. Um, and today, you know, the market and the economic data are pointing in the same way. And market data, you can look, of course, like I mentioned earlier, things like copper, aluminum, whatever, energy prices. Or you can also look at the performance within the stock market. And what's fascinating to me is if I look at the stock market in the past 6 weeks, 2 months, you've seen a real broadening out of the stock market. It used to be that it was tech and nothing else. And now all of a sudden, energy is outperforming, industrials are outperforming, consumer cyclicals are outperforming. Um, and what's fascinating is actually within tech, while the whole market is broadening out, within tech, you're seeing a tremendous narrowing of the performance, which to me is yet another symbol, another sign by the market telling you we're moving into a different environment here. The period where inflation was rolling over is over. The period where you had to worry about growth is over. From now on, the economy's picking up, and that's why you get the outperformance of value against growth. That's why you get the outperformance of cyclicals versus non-cyclicals.
Just on that note, I'll give David the word just a minute. You mentioned earlier, Louis, that a cut would be a policy mistake. Can you elaborate why?
Oh, we don't need it. I mean, simply put, the I think actually mentioning that you wanted to cut was a mistake by Powell. You still had super high inflation when you started to say, okay, we're done. We're going to look to cut soon. I'm going to look for excuses to Dave's point earlier. I'm going to look for any excuse I can find to cut. My experience I'm an emerging markets guy. I'm calling you from Hong Kong today. I've lived in Hong Kong for 25 years. And we manage money out in Asia. When I look at countries that have had inflation problems, you need once you get into an inflation problem, what you need is actually much tighter fiscal policy and much tighter monetary policy and coordination between fiscal and monetary policy that get together and say, we're going to crush this together. You haven't had that anywhere in the Western world. Let's be very clear. The central bank said, okay, I'm going to try to tackle this. And the fiscal guys, and this is true of the US, this is true of Europe. The fiscal guy said, yeah, you do your thing. I'm going to do my thing. I'm going to keep ripping. I'm going to keep spending. I'm going to keep running budget deficits of 7% of GDP. Now, how on earth are you supposed to get inflation under control when you're running budget deficits of 7% of GDP with full employment? The answer is you can't. Like, there is no textbook example of this happening. And so what Powell should have done, the policy mistake Powell has made, is he actually should have gone over to the Treasury and to the Congress and said, look, guys, we're all in this together. We're not going to tackle this inflation problem unless we work together. Instead, basically 9 months ago, he said, hey, job done. I think we're good. I think we're fine. And so politicians say, great, perfect, well done, you. I'm going to keep spending. I'm doing my thing. You do your thing. Well done, us. And we'll just keep rolling. And that was the policy mistake. Make no mistake about it, inflation's going to come back. Now, when you see this, and you know that the Fed has 800 PhDs on payroll, the only question you can have is, are they doing it on purpose or are they that stupid? I mean, it And for me, it has to be that they're doing it on purpose. The reality is once you get to over 100% debt to GDP, you have no choice but to inflate the debt away. So you can pretend, you can say, oh, I want to get inflation down, et cetera. But let's not kid ourselves. They always wanted 4 or 5% inflation to deal with the excess debt in the system. That was always the end goal. You go back to their declarations 3, 4 years ago, and they were all saying, "Oh, we can run inflation a little hotter for a while. We can, we can, we can be above target." That was always the goal. Now, of course, they don't want 8, 10, 12% inflation, um, but they'd be very happy to keep it around 4 or 5% and keep it there for the long term. This is where we're heading. Um, and you know what? If they make it, if they manage, it's very hard to manage that 4 or 5% inflation. I always like to joke that, and having inflation in the system is like being pregnant. You start off a little pregnant, then you get a lot pregnant, then you've got a problem for 18 years. And 18 years is if you're lucky. Um, they so you might want to keep it at 4 or 5%, but that's like saying I'm going to stay 3 months pregnant. Um, it's gonna be hard.
Okay, David, here is a quote from Jamie Dimon. This just came in from the Wall Street Journal today. JP Morgan Chase CEO Jamie Dimon warned that U.S. interest rates could soar to 8% or more in coming years, reflecting the risk that record high deficit spending and geopolitical stress will complicate the fight against inflation. Huge fiscal spending, the trillions needed each year for the green economy, the remilitarization of the world, and the restructuring of global trade are all inflationary, Dimon wrote in an annual letter to JP Morgan Chase shareholders on Monday. I think this is reflective of some of the themes that Louis touched on. Can you respond to that, David? Do you agree with Dimon's view?
I do. I'm a huge fan of Jamie Dimon's and have been for many years. In fact, I think he'd make a great president someday, CEO of America, but different story. So, yeah, I think that you're really, with that quote from Jamie, you're talking about one of the things that Louis and I feel most passionately. He's talked about it some, but I mean, to really drive it home, and he was talking about the deficit spending and how difficult it is to get inflation down, which is true, because you have had the situation where you've had the Fed applying the monetary brakes and the Treasury on the fiscal side with the pedal to the metal. And then recently, and I think that Powell does have to take some blame for this, in his famous flip-flop in December, where he said he wasn't even thinking about rate cuts. And then 3 weeks later, or maybe it was 10 days later, he was talking about, we're probably going to do that. And it was off to the races. So that created, even though the Fed hasn't cut once, it created this tremendous easing of financial conditions. And I think, as Louis was alluding to, I think it's very true that the Fed has become a much more politicized organization. I think it's always been, to a certain degree. It tried to be independent at times, but I think it's much more politicized than it has been in the past, which is why I think we are in a secular or structural inflationary phase. But you also brought up, or Jamie did, what I call the great green energy transition, which I think is very inflationary, as is the entire reindustrialization of America. And I'm not saying it doesn't need to be done, but like Louis said, there's been, as we know, there was a lot of offshoring of the U.S. industrial base over the last 40 years. We're trying to put that back in place and very quickly. And, we're trying to go from inventory management that was just in time to just in case. I mean, there's all these things which to me seem like they're long-term inflation propellants. But you just look at like this CHIPS Act and these facilities that are being built. And guess what? They're getting government subsidies to do it, which were just increased, as you probably saw. And they're way over budget. They're just like a government infrastructure project, way over budget, way late. How's that not going to be inflationary? And where's that money going to come from? I mean, kind of to Jamie Dimon's point, it's going to have to come from the government running fiscal deficits. And so far, they've been able to get away with it. But I think what you really need to be watching is the bond market. And I've talked about this before, but bond yields fell precipitously at the end of last year. They got down to about 385 on the 10-year Treasury. I think it closed at 442 today. That's a big, big increase in a relatively short time. And forget going to 8%, like Jamie's talking about. If we get back to 5 or 5.5, 6, I mean, those start to become very scary numbers to the stock market. But it also incurs a lot of damage on bondholders who really don't need to take more losses. They've been doing just fine in that regard.
By the way, you wrote in a note.
Can I?
Yeah, please.
Sorry, can I dive in on this? Because I think Dave's point is super important. And perhaps I can couch it in terms of my own career. So I'm 50 years old, and when I started in this business, US debt to GDP was basically 30%. Um, 25 years later to 30 years later, we're now at 130% debt to GDP. So US debt to GDP has increased by 100%. Now, in essence, there's nothing wrong with increasing debt if you're taking that money and doing productive things with it. If you're building highways, Hoover dams, um, railway systems, things that are going to boost your productivity down the line. But here's the question I would ask: when you look at that 100% debt to GDP increase in the U.S., what did you get for all that money? You know what? Where did that $25 trillion of additional debt go to? Um, and and what investments are going to give you the return down the road? Now, the reality is that when you look at where the U.S. government spending is going today, you take Social Security, Medicare, Medicaid, the military, and the interest payment, and it's already more than your tax receipts. So when people say it's okay, we're going to borrow a bunch of money and make a bunch of productive investments into green energy, into a new power grid, to be honest, I would say that should have been done 10 years ago. Now, granted, it's the old Chinese saying, the best time to plant a tree is 20 years ago. The second best time is right now. Maybe it's not too late to invest, etc. But then you get to the question, okay, fine. Now we're going to increase the debt even further to finally make the productive investments that we needed. But then you get to the question is, are those investments really productive? Because a lot of these green investments, fundamentally, what you're proposing to do is take a source of energy that is already massively productive, natural gas, oil, and replace it with a source of energy that is perhaps less polluting, but definitely less productive. Now, at a time when, given the amount of debt that you have in the system, you need to be as productive as you can, if only to service the debt. But the whole greenflation thing is about is we're going to pile on more debt to become less productive at a time where we already have a ton of debt. To me, it seems like madness.
Right there with him. It's insane. But we're doing it, and the stock market seems to think it's just fine. And, on a near-term basis, I mean, I think that's something we have to acknowledge, and that's why we didn't have a recession last year. I mean, you can say there's other reasons, but I think by far the most important was we went from a federal deficit in fiscal year 2022 of $1 trillion to $2 trillion in fiscal year 2023. And right now we're on track for something like $2.5 trillion. So and I didn't see that coming last year. I don't think too many people did. And it's just almost, we're talking about the impact on inflation, but it's almost impossible to have a recession when you have the fiscal deficit doubling. And at a time, as Louis already noted earlier, when you got basically full employment.
So I want to say one quote on this.
Yes.
I want to say sorry we're not
okay.
letting you interview. We're sorry, David.
No, please.
Over your show.
Please Please continue.
My very favorite economist was a guy called Jacques Rueff. He was a French economist in the post-World War II era. He was the one who advised de Gaulle. He looked at the U.S. Balance of payments. He looked at the U.S. deficits, and he told de Gaulle, "You better get your gold out while you still can." And de Gaulle did that, of course, in 1965 and 1966. Anyway, Jacques Rueff has the best quote on inflation, and Jacques Rueff says, "Inflation is subsidizing expenditures that give no return with money that does not exist." And when people talk to me about the Green New Deal, about bringing back semiconductor production into the U.S., this is exactly what inflation is: subsidizing expenditures that give no return with money that does not exist.
There you go. That should be the highlight of the show right there.
Yeah, that was a great quote. Thank you. I'll write that down. So, okay, I was gonna say, both of you assuming that inflation is going up, I think the underlying assumption here is that we're not going to get a recession. I think you just addressed that, David, because recessions have historically been disinflationary, if not outright deflationary events. I'll let anyone comment on this.
No, I think that's right. I think it's tough to do it. Now, we're talking on a near-term basis. And to me, I think when you run these huge deficits, and to what Lou was talking about a while ago, what's the return that we've gotten on this enormous increase in our national debt over the last 25 years? And we were running surpluses at the end of the 90s. Alan Greenspan was worried we were going to have no treasury bond market by 2010, would all be paid off. That was a great forecast. So, what if you look at how is the U.S. done? I mean, because the theory is when you do all this immense deficit spending that you get accelerated growth. But in reality, the U.S. growth rate over the last 25 years is half of what it used to be. So I think that's really your proof right there. And so this idea that all this money that's being dumped into the system from the federal government's, it's not the Fed printing money right now. In fact, actually, they're doing the opposite, which is going to be interesting how long that can exist, quantitative tightening. But certainly the Treasury has been just opening the floodgates. And so while that creates, it's kind of like crystal meth, and Louis knows this better than I do, that, the stormtroopers, the Nazi stormtroopers in World War II took crystal meth and it fed the myth that they were superhuman because they were for a while. But then when it wore off, they crashed. And I think that's the same situation. You get a near-term lift, you can say, well, it's like amphetamines, whatever. But then the long run is it actually retards economic growth. And this is actually a core thesis of Lacey Hunt. And I think he's exactly right. And Louis' father, Charles Goff, says much the same thing. So really, the stock market, if it was properly discounting the future growth rate, it would be selling at a fairly modest multiple instead of one of the highest ever. Now, where you can get, this is something I wanted to bring up, because I think right now the cyclically adjusted KPE on the U.S. market is about 34 times. Louis, I think in China it's 10. Is that about right?
Yeah, no, it is, and I'm very happy to talk about China. I want to make a couple of other points on what David said, because there's a guy on Substack I love to follow. He's a great guy. He's called Paulo Macro. I recommend all you guys subscribe to his Substack. And Paulo has a great catchphrase, which is that nobody's really ready for an inflationary recession. That I think we in the Western world for the past 30 years have been conditioned to think recession equals falling prices, equals overcapacity in the system, et cetera. But if you've spent any time in emerging markets, you know that you can have periods of, you still have high inflation because of high budget deficits, because of excess money printing, while the economy does nothing. And this creates an illusion, because prices are still going up, it actually creates an illusion of prosperity that is not there. Um, and I think we in the Western world, because again, we haven't experienced that for 30 years, we're not ready for this illusion of prosperity that the inflationary recession brings. And the problem with that illusion of prosperity is that it dramatically increases social discomfort. Because if you're at the bottom in an inflationary recession, the bottom people all of a sudden can't go to the supermarket or can't pay their electricity bill. And so that is really the risk in the system. But by the way, if it happens enough, then at some point you get a big shift for political change. This is, of course, what you've seen in Argentina, where you go down the path of inflationary recession long enough, and this is what you had, of course, in the U.S. in the late 70s and in the U.K. This is what brought in Thatcher. This is what brought in Reagan. And this is what's bringing in Milei today in Argentina. Now, against all this, and to Dave's point, what's fascinating to me is there's one country that's on a completely different dynamic than anybody else. One country where there is really no inflation whatsoever, and that is China. And that is the one country today where you are seeing aggressive easing of monetary policy, aggressive easing of fiscal policy, and it is the one country that absolutely nobody is interested in for whatever reasons you want to pick. Taiwan, or Xi Jinping's a bad guy and he's going to take all my earnings, or he's going to crush my stock. You name it. There's lots of reasons to not be involved in China. My personal belief is that we will look back 3 years from now and think, hold on, in 2024, the Chinese government was intervening and putting a floor under stock prices. The Chinese government was putting pressure on companies to start doing buybacks when before they were basically forbidden from doing buybacks. And if I look at the Chinese big tech stocks, the JD.coms, the Pinduoduos, the Alibabas, they're all trading at anywhere from 35 to 100%. Their market cap is 35 to 100% of cash that they have at the bank today. They're all trading on single-digit cash flows, but price to cash flows, with cash flows growing at double digits. I think we'll look back and think, why didn't I fill my boots with these things? Um, I know the answer because Xi Jinping is a bad guy, because Taiwan, because this, because that. But basically, because of political risk. That's it. Like, if you're willing to take on that political risk, the value proposition today in China's big tech stocks is simply unprecedented.
This is kind of an interesting point. I wanted to bring this up because Louis wrote a piece here recently where he's had discussions with money managers because he's been on this world tour here recently. And they do have a lot of the great money managers as their clients. And so I think he got a lot of pushback on maybe it wasn't Taiwan Semiconductor specifically, but it was Taiwan in general. And then he said to the people that were criticizing that as an investment idea, well, do you own NVIDIA? And they, oh, yeah, we love NVIDIA. We own a ton of NVIDIA. Well, okay, well, if something happens to Taiwan, if they get taken over and Taiwan Semiconductor can no longer produce semiconductors, what's that going to do to NVIDIA? And I think thought that was a brilliant point to make. So, Louis, do you want to elaborate on that one? Since it was
No, for sure. Like today, most of the people tell you I can't invest in China because China's going to invade Taiwan, but I'll go out and buy Nvidia. I mean, it makes no sense. Like I firmly believe that China's not invading Taiwan, and I'm very happy to discuss that if you want. But if you did believe
they are
China's
they are
not
not.
invading,
Sorry, I didn't hear you.
they're not. They
They're
are
not.
not.
Okay.
China is not invading Taiwan for a number of reasons that we can go into if you want. But the the idea that China, that I believe China is going to invade Taiwan and therefore I'm going to go out and buy Nvidia, to me is madness. The day China invades Taiwan, which again I think is never, but if it did come, if I'm wrong, China did invade Taiwan. Nvidia is a chip company that can't produce chips. Like, what's the value of that? It's pretty close to zero.
You don't think China is going to catch up to the Taiwan fabs in terms of their sophistication of the chips?
Um, I think they're trying really hard. And my experience in China over the past 30 years is when China puts a lot of manpower and a lot of money into a project, I usually it tends to work. I'm sure you've seen that interview of Elon Musk 7 or 8 years ago being asked whether he was worried about Chinese electric cars and him laughing it off, like, "Oh yeah, right. I'm going to worry about Chinese cars," and literally laughing during the interview. Now he's asking
he's
for
not laughing
tariffs against
anymore.
Chinese cars. Sorry, he's not
He's not
laughing anymore.
laughing anymore.
No, he's not laughing anymore. 7 or 8 years later, he's asking for tariffs against Chinese cars. So um, all this to say that the China today graduates every year more engineers than the U.S. has. Like every year, China graduates more engineers than there are engineers in the U.S. Um, so you throw enough of these guys at a problem, I think you'll find some solutions over time.
I do want to get to David's outlook on the market and talk about the market. But since Louis, you brought this up, let's talk about Taiwan. It's a pivotal point of geopolitical tensions around the world, where some would say the hotspot that may spark World War III. But your thesis is that that won't happen, an invasion of Taiwan or an outright kinetic conflict. You're based in Hong Kong currently, so I'm just curious as to why you formulated that thesis and the sentiment on the ground in Hong Kong and the mainland right now.
Look, I think there's so many different reasons, but the very first one is that we have to acknowledge that invading Taiwan is logistically extremely hard. Um, it's an island 100 miles offshore
Well,
from.
maybe let's rephrase the question. Maybe not so much an invasion with boots on the ground. Maybe just an attack. Maybe with missiles or cyber warfare or bombs. Yeah,
Drones.
drones. Yeah, drones.
So what does China gain by doing that?
I yeah.
Yeah, it's like what's the point? Like, so you go now. Don't forget, that China used to be built along its two rivers, right? It used to be China's economic center was built along the Yellow River and the Yangtze River. Um, in the past 20 years, all of China's economic center has moved along the coast. So what China can throw on Taiwan, Taiwan can throw on China. It's mutually assured economic destruction. All of China's prime economic zones are all across the straits from Taiwan. If China can send missiles, Taiwan can send missiles. And so you've destroyed each other's cities, and then what? Like, what was the point of that? Now, I think one big difference, because people draw the parallel between Russia and Ukraine, is between 2014 and 2022, you had 14,000 dead in the Donbass. Every day when he woke up, Putin was getting attacked from his right, saying, "Hey, what are you doing to protect our Russian brethren that are sitting in Ukraine that are dying?" Um, there was a ton of bad blood between the two countries. There is no bad blood between China and Taiwan. There is, Xi Jinping doesn't wake up in the morning being harangued by people saying, "What are you doing about the poor children being shelled in Taiwan, being told that they can't speak Chinese, being told that they can't eat Chinese food?" You have none of that. The situation is extremely different between Russia and Ukraine. China's take on Taiwan is that eventually it will fall on its lap because economically it's becoming ever more integrated. Today, if you look at male Taiwanese passports holder that are between 18 and 60 years old, almost a fifth of them now live on the mainland and work on the mainland. And increasingly marry Chinese women, form families in China. The economic integration is happening. So yeah, I think now the reality is that today, why does the US care about Taiwan? The US cares because TSMC has become the world's most efficient producer, right? Um, so let's project ourselves forward 10, 15 years. With all the investments that China makes, what if China is in 15 years' time, the world's semiconductor producer? Option one. Option two, it's like, no, 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 China's not going to crack the code. Instead, we'll have forced TSMC to transfer all their IP to the US, and the production of semiconductors will have moved to the US. Either way, in 10, 15 years, either the IP is in the US or the production is in China. Nobody will care about Taiwan in 15 years' time.
Okay. Interesting discussion. David, I want to move to you and talk about the markets now. By the way, David Hay is the author of Bubble 2.0 and then Bubble 3.0, which you can find on Substack, I believe, right? So yes. Please do check that out.
Really, it's only Bubble 3.0. I can't take credit for Bubble 2.0.
Oh, okay.
Gotta give that one down to Greenspan.
Okay, that's funny. All right. Well, you documented.
But just since you brought that up, I think it's actually a really good lead into this, what you were going to ask me about as far as the stock market, because there are a lot of parallels with what we're going through now. And when I wrote Bubble 3.0, which I really wrote it in 2021 during what I was pretty convinced was peak insanity, and we published it in early 2022, kind of just in time, which is why we did it on Substack. But it's amazing. We've got, maybe it's Bubble 3.5 or 4.0, I don't know, but we've got a lot of bubbly conditions and events happening once again. And I don't think it's so much the Magnificent Seven, which is probably now the Magnificent Four. Tesla's clearly out, but what Apple, I think, is down on the year now. And anyway, it's definitely a dwindling cohort of glamour stocks, but it's where I think the real danger is. And Louis remembers me saying this back in 2021. I was calling them the cops, the crazy overpriced stocks, to be polite, which were trading at outrageous valuations. Those were the ones that went down 70 to 80% in 2022, much more than the NASDAQ. A lot of those things have reinflated and are trading at just outrageous, 300, 400 times earnings if they have any. Or look at Wingstop. I know that's not tech, but it's 150 times earnings. That's a lot of chicken wings. So that's where I think when you get to that level, and you can see these things in Investors Business Daily every week where they've got all these crazy PEs displayed. It's just, I think that's where people are going to get nuked once again, or you look what's happening with the SPAC revival. And of course, the crypto world is absolutely going nuts. And, maybe Bitcoin's worth it. I kind of doubt that it's worth that much, but who knows? But certainly all those peripheral things are probably, worth zero, especially something like Dogecoin. So it's the animal spirits are back. And it's amazing. I don't think anybody would have predicted. I certainly wouldn't have that'd be happening with the Fed funds rate over 5%. You would have thought that would have just, wrung out the speculative juices. But clearly that's telling us that that's not a punitive enough interest rate to really to avoid these casino-like conditions in the financial markets. But I do think it's going to be the bond market that it's going to be the Achilles heel, as it was back in 2022. And for a while last year, I mean, it was when bonds came down sharply at the end of last year, that's what helped drive the stock market in this great rally that it's had. And it's been fed also by credit spreads. As you know, David, and Louis knows this very well, credit spreads are very important. They get very little attention. I think that's a huge mistake on the part of the financial media. And they're super tight right now. So you've had both falling interest rates for a while and then narrowing credit spreads. The credit spreads are still super tight. But when they're super tight, they really can only go one way.
Is it possible, though, that tech stocks are expensive on a valuations basis, mainly because they're good companies and that AI is the new revolution and people actually do value these stocks and it's not just hot air? Maybe there's some fundamental truth to this?
Yeah, I think that's true. That's why I wouldn't pick on some of the high. I mean, NVIDIA, as long as the earnings stay there, NVIDIA is not overpriced. I think the problem is going to be on the E side of things because it's a chip stock. And let's face it, chip stocks are notorious for when they get into a boom cycle, the customers double, triple, quadruple order. And all of a sudden, one day you wake up and you find out these orders are getting canceled, and that doesn't really compete when you've got the kind of estimate revenue increases and earnings increases factored into that one that you have. But again, I don't think that's the area that's outrageous. Certainly don't think Google is crazy overpriced at 22 or 23 times earnings. It's these other names that are much lower quality. And where it was a disaster in 2022. It's amazing to me that people have come back for more punishment. But look what they're doing in crypto. So it's just people don't seem to learn their lessons when these bubbles blow up. And I don't know how they keep getting more money to come back and for more punishment, but they do.
So I think on this, I would say that, one of the feature of the past few years for the US and which has helped support valuations has been the lack of primary activity, the lack of IPOs, the lack of rights issues. My favorite stat is that if you'd put $100 in 2014, 10 years ago, in Chinese stocks, today you'd have $106. It's been terrible, horrible decade. And all your money was obviously made from dividends. That includes the dividends, by the way. If you'd put 100 in 2014, 10 years ago in the US, today you'd have $338 with dividends reinvested. So the US has gone like this and China's gone like that. And here's a super fun number for you. In 2014, if you took Hong Kong, Shenzhen, and Shanghai together, it was 27% of the market cap of New York Stock Exchange plus NASDAQ together. So all the Chinese market together were 27% of all the US markets together. Since then, US market has tripled, Chinese market has gone down. What do you think the ratio is today? And here's the magic. It's still 27%. Because in the past 10 years, you have had nothing but share count contraction in the US. Apple buying back its shares, Microsoft buying back its shares, so on and so forth. Private equity, you name it. While in China, you had constant issuance. All the big IPOs, Pinduoduo, JD, you name it, they came to the market. They issued shares. So the overall market cap ratio has stayed the same. Now, today in China, there are no more IPOs. There are no more rights issues. You don't want to be an investment banker in Hong Kong. There are no deals to be had. Over the next few years, are we going to get the same share buyback activity in the US? With interest rates much higher? I doubt it. In fact, what seems to me more likely in the coming years is that in the US, right now you have about 3,000 companies that have been basically sponsored by PE or VC that need to be listed in the next 3 years for the PE funds to start paying back all the money they got. So for the next 3 years, you want to be an investment banker in New York. You don't want to be an investment banker in Hong Kong. But that probably means you want to be an investor in Hong Kong and not in New York. Like when Wall Street sells you things, you don't want to buy it.
So I'm saying, when the ducks are quacking, feed them. And Wall Street does that really well. But I think that's a great point that he's making, David. I think that's so important. And also, I would chime in by saying that you had the share count contraction, but you also had falling interest rates in that period, which has now gone up. I know Louis touched on that, but also tax rates. So how much of the big earnings, superior performance by U.S. companies has been a function of those three factors, and it's a big one. So I think he's exactly right, and I really agree.
The
Yeah, and I
tax
think
rate
it is.
matters. Sorry to interrupt, Dave. So I'm really sorry. Tax rates really matter because in 2025, the Trump tax cuts are supposed to expire. Now, you could say, yeah, but Trump's going to get reelected and he's going to do it again, and we're going to get more tax cuts, possibly. But then the budget deficits get bigger because right now in the CBO projections, projecting 7% budget deficits for the next 10 years, is embedded in that is the idea that the Trump tax cuts are expired. So
And also that
then you
there's
get
no recession
also that there's no recession. So
for 10
so
years.
for 10
Recessions are
years,
gone.
which is they've been made illegal. We all know that. So then you get to the question of, hold on, if budget deficits get bigger, how do they get funded? Where does the money come from? Is that money coming out of the stock market to fund the government? Money's got to come from somewhere. At the end of the day, you could say, well, the Fed will print it and the Fed will provide the money to the government that the government needs, which is what I believe. But this goes back then to our discussion about inflation and about the long-term value of the dollar.
Okay, let's wrap up on the on asset classes. Your outlook for asset classes. We'll talk about the dollar in this part of the conversation as well. So let's just list the things that have gone up just off the top of my head. Oil, the broad stock markets, tech stocks in particular, Bitcoin, cryptocurrencies, gold, and gold mining stocks to a certain extent. The DXY, emerging markets. I'm looking at the EEM. That's gone up as well. Which of these things that I've just mentioned do you think has the most legs for the remainder of the year?
I'll kick off. All right. Look, I think we've started a gold bull market. I think most people misunderstand the bull market in gold that's happening. They look at it and they look at their charts with, the gold correlation to real rates and like, well, how can this be? And the dollar's strong. How can gold go up? The reality about the bull market is very simple, is that all the demand is occurring in my part of the world. It's occurring in Japan, it's occurring in China. And it's occurring in these two places because local investors are loaded with cash, very high savings rates, and they're seeing their local central banks remain very, very easy. In fact, it's fascinating. On March 11th, the BOJ came out and said, actually, we're going to keep yield curve control for a while. Everybody was expecting yield curve control to be over. The yen went from 146 to 152. And the volume on the 1540 JT, which is the Japanese gold ETF, the equivalent of GLD for Japan, the volume went up 6 times. Like they also just that week, and it's kept ripping since then. Because if you're a Japanese investor and you're told, look, yeah, we're going to let the yen keep going down, you're like, okay, fine, I'll buy gold. Now, fast forward 10 days, and as the yen goes down, China basically says, you know what? If the yen's going down, we're going to let the renminbi go down too. Like we've been defending the 72.2 level, but we're done defending this. We're letting the renminbi go. Now, cash at the bank in China has never been this high. Chinese people are no longer, the Chinese government's pushing money in, but Chinese people don't want to buy real estate, don't want to buy stocks. And now they've got their central bank saying, we're going to let the currency go. So what do? You buy gold. And so all of a sudden, the Chinese gold ETFs are trading at 30% premiums. You look at the way gold trades, it shoots up in the morning, Asia time. And then by the evening, by the time the US comes in, it goes down. What's fascinating to me is that amidst a roaring bull market on gold, and it is a roaring bull market, the number of issued shares on GLD is actually shrinking. Like US retail investors have had zero interest, like none. And which perhaps helps explain why the gold mining stocks have also, frankly, they've gone up the past 2 weeks, but let's face it, that brings them back to where they were at the beginning of the year. If that actually, like I think Newmont and Barrick, the two biggest ones, are still down 5 or 6% for the year. So this thing is, make no mistake, this thing is only just starting. The gold bull market ends when the BOJ and the PBOC change their monetary policies. When they turn around and say, you know what, I want a stronger currency, I'm tightening monetary policy, I'm raising interest rates, and I want a stronger currency. Until you see that, gold will continue to rip. And my experience in Asia is that Asian investors are the ultimate momentum investors. Things go up, they buy more. It goes up more, they buy even more. They are the ultimate momentum investors. Momentum has started. And this thing is off to the races. To me, that's the lowest hanging fruit.
Just on
really
that note, Louis, I've seen data that gold ETF ETFs rather have seen outflows this year, not inflows, net outflows.
No. In the U.S.
In the U.S.
In the U.S., they've seen outflows. In Japan, in China, they've seen massive inflows. Right now, the biggest gold ETF in China is trading at a 30% premium to the price of gold. Like
That's amazing.
it's so yes, you've seen outflows in Asia, but which is why again I'm saying the bull market in gold is centered in Asia. It's off to the races, and there is so much money in the bank accounts in China and Japan, and every day it's making its way into
So
gold.
it's not the central banks pushing it up with their stockpiling of gold from last year.
They're also doing some of that, but I really think it's the retail investors here at this point. And it's like a runaway train. You do not stand in front of it. Now, you don't have to participate. You can say, look, this makes no sense. I'm standing aside, etc. But when you get a roaring bull market, there's only two things you can do. Either you participate in it or you stand on the side. You don't short it. So I think the big question becomes for retail or an equity investor, how do you participate in this roaring precious bull market? You can buy the miners. They're cheap, but historically they've been terrible stewards of capital. You can buy the gold royalty plays, but they're expensive and they tend to be lower beta. Or you buy the gold brokers, the A-Marks, the Sprott investments of this world. And yeah, those are I think really the various plays you can play on this. But this is the bull market that's unfolding. For me, this is the low-hanging fruit. And we haven't even touched upon the crazy fiscal policies in the West, et cetera, that down the road favor, like at some point, Western investors will realize, yeah, you know what, inflation's coming back. I need to have some gold as well. And that part hasn't even started.
David, same question, but just an extension on that. So you're the CIO rather of Evergreen Gavekal. I believe over $4 billion of AUM, diversified fund. What is your outlook on the assets that we've talked about so far, and hence how are you allocating your portfolio?
We've been big bulls on mining stocks and gold itself, as a matter of fact. So it's, it started in 2020, and Louis and I both felt the same way that the pandemic response was going to be highly inflationary. And they had a tremendous performance in 2020, topped out in the fall. And then from that point, really performed very poorly. Unfortunately, did a lot of profit taking. We were aggressively rebuying them even fairly recently. And Louis mentioned Sprott. I think that's a great way to play it. And he's done very well with A-Mark. I think that makes a lot of sense. I do worry that they're a bit overbought right now. And I think that's kind of just true in general. And there could be a pullback. But that's the way bull markets operate. And you get these pullbacks, but they don't pull back as far as a lot of people want to see them. They'll never get down to where, I think that a typical U.S. investor would come in until it's way too late. And that's typically what U.S. investors do, is come in right at the end. And they'll catch a little bit of the end of the bubble or the bull market. But I do think we could actually see a true bubble in precious metals, which I'm old enough. I mean, Louis was talking about the inflationary 1970s. We had a bubble in precious metals back then. And we had basically an inflationary recession. We had a stagflationary type of environment. And I believe, and I know that there are some very bright people that totally disagree, that this decade is going to look more like the 1970s. So I think, just it's not that hard to go back and see what asset classes did well in the 1970s and which ones did poorly. And the high multiple stocks, which were very popular at the beginning of that decade, that's when we had the Nifty 50, did very poorly. But if you bought gold miners, if you bought energy, if you bought agriculture-related stocks, you had a great decade. But nobody was in them. I think they're just greatly underinvested right now.
Speaking of the 70s, at the peak of the gold boom in the 70s, the Dow to gold ratio was near 1.4, right? It's currently at 20. So huge contraction of multiples could be expected if gold soars. Is that possible? Go back to 2, 1.4? 1.5?
Anything's possible. I wouldn't be around for that to happen. I would have sold way before that, but it's certainly possible. I'm real good at selling too early, but I try to do things gradually, methodically, because they do run up more. So that's kind of fun. I mean, I think that, Louis and I are both fortunate enough to be in the early stages of this new bull market. I personally still like energy the best because it's so essential to the world. And I think that there's been such a propaganda campaign against fossil fuels that we talk about underinvestment and inventories are just shockingly low. I think it's one of the greatest setups I've ever seen. And some of those energy stocks still have not really kicked in like they should. But I think they also answer your question. I'm a big believer in looking at multi-year breakouts. Louis, sick of hearing me say this, but there are some interesting breakouts happening. And if you look at the high dividend stocks, the dividend aristocrats, which have been huge laggards over the last 9 years, they're starting to break out. Mid caps have broken out. So I think that's where I'd be looking. There's a whole bunch of stocks that are breaking out across a variety of industries. And it don't have to be in tech, which is, to Louis' point, that you are seeing this broadening out occurring. So it could be that we're basically back to where we were. I mean, to use another historical analogy, in what was been in the business for over 20 years when the tech bubble burst, and it was the Great Rotation. You actually did really well for several years if you were underinvested in tech and overinvested in more value-oriented, industrial, cyclical, inflation hedge type names.
All right.
On this, Dave, I don't know if I really trust the Dow gold ratio. But I really like the gold energy ratio. The gold energy ratio, because it intuitively makes sense. Energy is sort of, gold is sort of energy stored, but more importantly, the main reason you keep gold in reserves, if you're a central bank, you mentioned central bank buying, is to buy energy down the road, right? If you're India, if you're France, if you're South Korea, the reason you keep central bank reserves is to buy energy down the road. Now, on this, if you look at that gold energy ratio, I don't have it in front of me, so I don't know, but it is very low today. So energy relative to gold is super cheap. And here's the fascinating thing is if you look over 70 years, that ratio does go like this. So like Dave, I'm more bullish on energy than I am on gold, but I acknowledge that we are now in a gold bull market.
Okay. This is all the time we have for today. Very thorough discussion. I encourage everyone watching this to learn more from Gavekal Research. So on that note, Louis, where can we learn more from your work and your research?
Yeah, thanks a lot for having us. The best is our website, to be honest. I guess I'm still very old-fashioned. So gavekal.com for institutional investors. Then for non-institutional investors, Dave and I have a Substack. Well, when I say Dave and I, Dave does all the work. But I'll piggyback off of his efforts. So we have a Dave and I have a Substack with, again, emphasizing Dave more than me.
David, anything to add? Where can we learn about your writings?
So what Louis is talking about is our Haymaker _ Substack. That's where you can find a lot of my, but a lot of Louis' writings too. A lot of his stuff makes it up there as well. And then, of course, our website too for the other side of my career, which is Evergreen Gavekal. That's the money management side of it. And unlike Gavekal, we're very retail focused, a lot of high net worth individuals. And so, yeah, those are two different ways you can access our content. And thank you, David. Thank you so much for inviting us back.
No, my absolute pleasure. Thank you for joining us. Thank you for educating my audience. That was a great hour-long discussion on a lot of key points. So I learned a lot in the last 60 minutes, and I'm sure our audience will as well. So thank you. We'll put the links to your work down in the description below. Make sure to check it out. Thank you again, gentlemen, and we'll speak again soon. Thank you.